Making long-term retirement decisions in today's risky market is a challenge. That's why so many smart, logical retirees in Chandler are making the move for their 401k and IRA rollovers to licensed retirement specialist and fiduciary Steve Jur-itch with IQ Wealth Management in Scottsdale. Steve is a Kiplinger contributor and host of the popular daily radio show Mastering Money on Money Radio. Let's listen in on a recent broadcast. At any point throughout, you can visit our website by clicking the little circle with the I in the top right corner.
Who's making retirement great again? Kiplinger contributor, best-selling author, and leading financial advisor, Steve Jur-itch with IQ Wealth Management. Right here on Money Radio. Plan, invest, insure, retire, and stay retired. Now back to Steve.
Welcome back to Mastering Money on Money Radio, right after business for breakfast from 8 a.m. to 9 a.m., Monday through Friday, and any time of the day or night on your smartphone. Just download the free Mastering Money app. Mastering Money is brought to you daily by best-selling author and wealth manager Steve Jur-itch.
Hey, how you doing, everybody?
Steve is founder of IQ Wealth Management in Scottsdale, an independent registered investment advisor and fiduciary with asset custodian Fidelity Institutional. Steve is a local hometown advisor with national resources working with him and is part of an integrated financial network providing a solid succession plan, including Sterling Capital with more than $52 billion under management and more than 35 CFAs. He's the designer of the Black Diamond Dividend Strategy. It's time now for the Mastering Money Q&A session.
Yes, sir.
Today, I will provide the cues, which means that, Steve, you've got the A's.
Hey, I'll take it.
Steve, a lot of people retiring have both a lump sum and a pension, and there are others who are forced to choose between a lump sum and a pension.
Right.
So let's talk about the difference between taking a lump sum in retirement of $1 million in a lump sum or taking a guarantee of $50,000 for life for both spouses, and which is better?
Well, that's an interesting question because UCLA did a big study on this, kind of a behavioral science study, but also there's several professors over there right now that have gotten into the swing of things, investigating retirement choices that people are making. Wharton School of Business, of course, very big on it about why annuities make so much more sense than bonds in an environment when interest rates are so low and probably will stay low. Barring a miracle, we're in a big deflationary cycle brought on by all kinds of things. Global competition for labor. I mean, you can't compete with $7 an hour or $1 a day in other countries bringing products here. And then, of course, you have technology happening, and that's really taking away the need to pay people a lot of money to do work. Well, the fact is then you've got to find solutions that are built for the 21st century, not look back to the 80s and 90s when bonds were paying 5, 6, 7, 8, 9%. So the UCLA researchers did a big, long experiment asking people, what would you rather have if you're 60 years old and retiring, a lump sum of $1 million or $50,000 a year for life for both spouses. So when one passes away, the other just continues to get that $50,000 a year. And interesting how the results came out. A lot of people, it was about 50-50. Most people recognize that they're going to have a very difficult time turning $1 million into enough income without the risk. What they're finding, another study done by Prudential found that there is now a 54% chance of running out of money for a 65-year-old couple if they start withdrawing 5%. 54% chance. Why? Stock market's up too high, as we all intuitively get that feeling, and interest rates being so low. That combination is going to result in many people running out of money in their mid-80s. So the bottom line is that which is better? Well, here's the good news. In today's annuity market, if a person is rolling over an IRA or a 401k into an IRA, a 403b or a 457 plan, you can now roll over into a type of annuity where you still keep your lump sum. There's no choice. You get to keep your lump sum. There's an income rider that either you can start the income right away or you can delay it for a while. If you delay and defer, you can end up with an income that can far outdo that $50,000 a year. If a person is 60 and takes that income right away, let me just go to my GPS here. Let me just plug in, and we're using $1 million, but our minimum at IQ Wealth is $100,000. So just you can add zeros on or take them off, no problem. We just want to use numbers that we can see. If you started the income right away on $1 million, you're looking at several companies are up in the $40,000 to $45,000 a year range. But it's better if you can defer. Let's say you can defer for 3 years. Now you're at $53,000. Let's see, I'm looking at the winners here. $53,000, $54,000 a year for life, and you still have your lump sum. If you can defer for 5 years, heck, we are at the range, let's look, $66,000 a year for life, and you've built up your lump sum more. So the reality is you no longer have to make that choice. If you are being offered a nice lump sum, and the lump sums are greater now because interest rates are low. There's a legal thing that's a subject for a different show, but that's why the lump sum offerings are larger right now. They legally have to offer you more because of the low interest rate calculations. So my answer to that question is review your choices before taking that income for life. In this interest rate environment, if you can defer a few years, we can beat that lifetime income.
All right, so that answers that question.
Yeah.
Now, let me ask you another question here. Do you run into people sometimes, Steve, who have a larger net worth, but they still fear running out of money? And if so, do you think that's rational?
Well, I see it all the time, and I do, yes, believe it's rational. We just talked about the person who put all that money. It was a net worth of $10 million, started a golf course, spent $26 million, and he's dead broke at age 72. So, yes, people can run out of money. Do the simple math. This is something that's very important to know. If you're 60 and your wife is 55, let's say, she's got maybe another 40 years of retirement. If you're spending $100,000 a year, 30 years of income need with no inflation is $3 million. That money's going to have to come from someplace. Now, is it going to come from a bond paying you 2%? Is it going to come from bond mutual funds that are paying a coupon total yield maybe of 2, 3, or 4? And if they're paying 3 or 4, dig into that mutual fund. You're going to find there are junk bonds in that mutual fund, and look out. So the people intuitively know they're not going to have the income they need to last 40 years. All it's going to take is a couple of bear markets, and I submit that we're going to see a few more bear markets as time goes on. Intuitively, you look back and do some simple math. In 2000 to 2002, there was that reversal that reversed really a 17-year uptick in the stock market that was well over 1,000% gain. And suddenly you had a little 10% loss in 2000, a 13% loss in 2001, and then a 25% loss in 2002. So close to 50% of your money got taken away over a 3-year period. If you had just retired in 1999 and you were taking out 4 or 5% from that pile, I mean, you are really in a world of hurt. Think about the math. 50% from that 2000 to 2002 crash. Take 5% out for 10 years. That's 50%. Then you hit 2008. That's 50% of your money gone. That's 3 halves of your money in a matter of 10 years. So yes, I do believe it's not irrational to worry about running out of money. Most important thing that we talk about there is then how do we combat that? And we do believe that our safer bucket system, where we have an income bucket and a growth bucket besides your cash bucket. And if you had $1 million and we were getting you 6 or 7% on $400,000, well, that's $24,000 or $28,000 in combination with your Social Security and other pensions. We could probably get you to the income need you have, where that's $80,000, $90,000, $100,000, $110,000. We have people with $150,000 a year coming in, guaranteed from annuities, Social Security, and pensions, no debt, and they don't even have $1 million. I mean, they built it up over time, and they're in their mid-60s. Is that superior to someone who has $1.5 million, still has a mortgage, and is trying to make it all work with a up and down stock market and bond mutual fund portfolio? We don't think so. We think that if you can get, let's say, $28,000 a year from $400,000, and that's guaranteed for life for two people, and that's the equivalent, let's say, of a 7% income for life, and your lump sum is still in there protected from the stock market. The other $600,000, even if all you get is a 6% return on it, because you're not having to dip into it, that can grow to $1,026,000 by year 12. By year 10, and by year 15 at 6%, you'd have $1,356,000 sitting in that growth bucket where you reinvested your dividends. If you can get 8%, you'd be at $1,700,000 using the $600,000 growth bucket while continuing to receive that income for life. So it's a much better organized way to manage your money.
To learn more about making the move for your 401k and IRA rollovers, or to hear the rest of the show, click the link to visit the IQ Wealth Management website. Click the link now if you want to retire and stay retired with the right strategy for you. Take a few seconds and click on the website link now.